Hey guys, welcome to the channel. Michael Garcia here, and today I want to talk about the term properly structured IUL, and really I want to talk about debunking the myth of the properly structured IUL, right? And I think it's a term that is kind of thrown out there very loosely. If you ask different agents what properly structured is, uh, there's definitely a group that's going to say one way. There's other people that'll tell you, oh, well, this is properly structured. And I kind of went over it in one of the other videos we did, the National Life Group policy. And so everybody has their own properly structured term. And what I want to get at today is this conversation is actually prompted by a Facebook post where I got into a chat with somebody and we talked about what is properly structured. What does it even mean? Right. And I want to actually share my screen and kind of get into that so you get a basis. But what I want to do is we're going to debunk that myth. We're going to get into it and we're going to talk about properly sold IUL, right? Where are some places that you can sell IUL? Where are some places it will work? I can give you a couple of places here. But the idea of properly structured, it's kind of a myth, right? And so let me go ahead and share my screen and we'll start with this comment, right? This is the post that actually prompted today's video. So Cecia here put, what is more important, the IUL design or the IUL management? Now, the IUL design, what agents are typically talking about here is the funding of the policy. So it's not necessarily the design of the policy, but it's the funding. And if you look at my comment down at the bottom, I said, if you mean funding or management, both matter. You can't have one without the other, right? You can design a policy a number of ways. And so um, the designs, there's different cases and different reasons to design different ways or really fund different ways, right? Like I said, when agents are talking about this, most of the time they're talking about funding up to the guideline or the non-Mech premium, trying to get as many dollars into the policy as possible, but they're not actually changing the policy or the structure or design of the policy, right? And that's what I'm really trying to get at today. Um, everything is still there, right? Now, the management of the policy is after the fact, right? Remember, if you watched any of the other videos, you know that there's a lot of variables in the IUL policy in the language, right? So the insurance company can change things. So as a consumer, as an agent, you have to be on top of this. You have to be watching and paying attention, or your policy is going to underperform and you might run out of money and you might end up with a lapsed policy. So the management of these policies is extremely important, right? Making sure that the funding is there, making sure that we're not over leveraging the policy or misusing it. So the management, very important, but the design, you can do it a number of ways. And so I made that comment. If you mean funding or management, both matter, right? So he said can versus should. And I want to kind of get down here to my comment. And this is what we're really going to get into and break down. So I put CSIS. I guess what I'm trying to get at is what's a good design and what's a bad design, right? And just to give you some history on who CSIS is, um, he believes he is the gold standard of structuring IULs, so to speak, right? And so, um, but anyway, what I try to explain to him is it depends what you're trying to accomplish, right? Like a good policy is going to accomplish what it's supposed to accomplish, right? And that's really um, how you know if a policy was sold properly. Is it going to accomplish what it's supposed to? Is it going to accomplish what it was sold to do? Right. And unfortunately, for a lot of these policies, they're not going to. They've been sold as tax-free retirement. Not only that, but they're underfunded. I've even seen minimum funds where these policies are going to lapse in 15 years, like guaranteed. Um, and so it's just insane what you see out there. But I'm going to give an example here. So let's say Brian. So Brian, by the way, is an IUL agent. He's actually the head of this group right here. And so Brian's somebody that really studies the policies, really understands the different functions. And so he's going to take the time, number one, to educate the client. He's only going to sell policies that are funded, max funded, meaning up to the non-Mech limit before it becomes a Mech. So his clients are going to, fund the most possible dollars into the policy without it becoming a Mech, right? And then he's going to manage the policies. He's going to, follow up on an annual basis. He's going to pay attention. Hey, are these companies changing things on us, right? Are they lowering the cap rates? Are they raising cap rates, right? Different things. So Brian's someone who's going to, take all those steps. And so let's say Brian, who we know will have his clients fund the policy to the non-Mech limit, sells a policy for 50K in death benefit. It's increasing, and Brian's client is putting $500 a month into the policy, right? Now, on the other hand, let's say a WFG agent, and I put here, sorry, WFG, not trying to pick on you, but there's a lot of target premium policies being sold there, right? So let's say WFG agent sells an increasing IUL of 50K in death benefit. It sounds a lot like Brian's, right? 50K in death benefit increasing. However, their client only pays $85 a month in premium. So my question here is this: are these two policies designed differently, or, assuming the same product, are they identical? Right? You got the same death benefit, the same contract, the same language, the same functions, the same levers, the same indexing strategies. So I don't know, in my opinion, the term properly structured is a myth. And so what I want to do here, and we can get back to this, I'll continue. Now, properly sold or properly funded, properly managed, on the other hand, completely different, right? But there's so many agents out there, and it just drives me nuts every time I hear the term properly structured. It's like there's no such thing as properly structured, right? All the same risk, all the levers that the insurance company can pull are still there. You can still have losses when the market, doesn't perform due to the cost, due to, borrowing costs. And you can still over leverage and lapse the policy. So it's important to understand that. So let me go ahead and share. What I want to do is break this down. So I actually drew this out a little bit. So um, here's exactly what I was talking about. So here's Brian, right? And Brian sold the IUL policy, like we talked about, a $50,000 policy increasing. Now, Brian's client is paying $500 a month, right? So the cost of insurance for the 50,000 is right here, right? This bottom portion, which means all the money in this top portion beyond that is being funded into the cash value, right? Now, on the other hand, the WFG agent, look, IUL 50K increasing. Look at this. We have the same cost of insurance. However, their client is only funding $85. So maybe this client only has like $45 going into the cash value, right? So when an agent says properly structured, what they're talking about is this max funding that Brian's client is doing. But the reality is the policy itself isn't structured any differently, right? The same risk is still in the policy. What's really happening here is, if we kind of break this down to real simple terms, is Brian recognizes the risk, right? So Brian says, in order to compensate for that risk, we're going to make sure that we max fund the policy. And so what we're really doing here is we're throwing more dollars. We recognize a problem and we're throwing more dollars at it. Now, a lot of times when you throw more dollars at a problem, does money solve problems? Absolutely. Right. And in Brian's case, this may be true, right? Other times, more money It doesn't solve problems, right? A problem can just become a money pit. And so, it's important to understand. But the reason I share this is because the term properly structured drives me nuts. My goal is to hopefully have every agent in the industry stop using the term and start using terms more like, is it max funded? Is it properly funded? Is it properly managed? Um, is it properly sold? Right? Is it sold as a something that's not, or is it sold properly? Is it going to perform the functions that it's being sold to do? Right? And so, really, there's two ways you could sell an IUL. Right? There's two factors, and so if you look at this, there is a death benefit, there's protection, insurance, and then there's cash value, right? Which in this case, the cash value will add on to the death benefit um, in an increasing policy, right? So it'll be on top of the 50K. Now that cost for the 50K is going to increase here, right? That cost goes up every year, and that's part of the risk of the policy, right? And so when you're only funding $85, if this cost is going up, it's going to eat into that amount that the client's paying, right? And there's not going to be enough cash value for the interest to really grow and take, overcome that, overcompensate for the increasing costs. So there's two parts here, right? And there's the protection part, and there's the accumulation of cash value within the policy. Now, there's an old Chinese proverb, and that old proverb says, if you chase two birds, you'll catch none, right? Or if you chase two rabbits, you won't catch either one, right? And so the thing with IUL, I've seen it sold as a Swiss Army knife, financial Swiss Army knife, or it can perform multiple functions. The reality is, if you try to have it perform too many functions or both functions, you end up with none, right? Because if Brian has his client at 500,000 and his client says, "Hey, I want more protection," well, that increases the cost of insurance. Well, if the cost increases, then it's going to lower the amount that's going into the cash value. It's going to lower the amount that's compounding. And so what happens is the client's going to be very disappointed with the accumulation of the policy if that's what he thinks he's getting, right? On the other hand, in order to maximize the cash value, you have to minimize the cost, you have to minimize the coverage. So in order to get the best accumulation, well, guess what? You have to get the least amount of coverage. So you have to pick when you're looking at these policies, it has to be either for protection or for accumulation. But it really can't be for both, because when you go for both, you really end up with none, right? What's going to end up happening is you're going to end up most likely with a lapsed policy because it's just not funded the way it needs to be funded to stay in force, right? So let's talk about the two ways to sell IUL. So the first one I want to talk about is protection. Now, when you're talking about an insurance contract, the whole idea of insurance is to transfer risk from yourself to the insurance carrier. Now, when you read the contract with most IULs, you're going to find out that there's too many variables. You don't know if it's going to perform. In fact, it's likely not going to perform. Check out the NLG video where the illustration basically says it's not going to perform as illustrated, right? So we know if there's no guarantees, we run a big risk, right? So how good is an insurance policy where you're supposedly transferring risk, but now you have this big risk within the policy? So when you go for protection, you need to make sure that there's guarantees in place. Now, there are a few policies that will allow you to guarantee them, almost like a guaranteed universal life. They'll have a guaranteed clause in the index universal life. North American has one of these products. You can guarantee it to 120, and there's a cash value component to that, right? So most GULs, they're not going to have the cash value component, or it's going to be very weak and almost non-existent later on. but you're going to have a guaranteed death benefit, right? Now, in the IUL with North American, the protection builder, you're going to have cash value, but it's not what you think. It's missold, right? And so what I want to show you is it's even though there is the cash value, it's not a great accumulation tool. And so let's get into that illustration right here. So we have the protection builder. It's important to understand that you have to fund, there's certain minimums you have to meet to guarantee the policy, right? If you don't meet those minimums, you can't guarantee the policy. It can lapse, right? And the other thing too is a portion of your cash value must remain in the policy, meaning, yeah, it's there, but you can't take it out or you risk losing the guarantees. You start over leveraging, the guarantees go out the window. And so, but what I want to do too is show you, like, if you're trying to do both, it's just not going to work. So you look at the protection builder IUL. If you're going for accumulation, you would never, ever want to use this policy. If you look at the cap rates, here's the rates. So the S&P 500, if we look at the current index cap rate, 6.95%, right? If we look at the participation rates for the Fidelity, 140%, that's obviously, not a bad participation rate. However, if you watch the indexing video I did and learn how these proprietary indexes work, you're not going to be too happy with them, right? They're going to underperform. And so the best way to compare is to go by the S&P, right? So if we look here, we have a minimum cap rate 2% and a current index cap of 6.95. Okay. Now let's compare this to the Builder Plus. Let me pull that illustration up. So this is the North American Builder Plus IUL 3. So remember, not only is a portion of the cash value untouchable without the, losing the guarantees, but I just showed you a 6.95% cap. So if we look at the builder, which is more designed for accumulation, we have a 9.5% cap. So those guarantees, they come with a cost, right? And in this case, you're talking about 2.5% cost in the cap rate. If you look at the participation, 210%. So you're getting significantly less. You're getting more than 25% less interest, less cap for the protection builder, right? So it's important to understand it's just not a great accumulation vehicle, but can it be properly sold? Absolutely, because it's guaranteed to 120. It's a legacy play. It's going to do exactly what it's supposed to do, right? It's going to leave the death benefit. So properly sold, it can definitely be properly sold, and it can definitely be for, potentially a guaranteed death benefit at maybe a lower rate than maybe a whole life. Maybe if the budget, is a little bit lower than you'd like, and the cash value is not too important, then I would maybe look at a vehicle like the protection builder, right? Now, on the opposite end of the spectrum, you can do a Mech, right? So this is for accumulation. So you might have a client with a lump sum, and maybe they want to do a Mech, meaning they can fund the policy. Now remember, you have certain tax benefits. What most people sell as tax-free retirement, it's because they're taking loans from the policy. So when you take loans, it introduces a new cost, which the leveraging of the policy introduces the risk, and that's where you can end up with lapsed policies. So what I like about the Mech is now not only are you funding to the guideline, but you're funding beyond the guideline, right? So you're funding more than the 500 that Brian's client is funding. And so what's happening is you're shrinking the cost of insurance to such a small percentage of the policy that you can pretty much mathematically guarantee your policy through the interest credits. in certain policies, right? And so not only can you do that, but on the other end, when you go to borrow the money, remember, you cannot borrow the money tax free anymore. Um, you have to now take distributions, which are going to be taxed. But what does this do? It actually takes out the risk from being over leveraged. It takes out that loan cost. And so you don't have that same risk that you would in a IUL that was sold as a tax-free retirement vehicle, right? And so that's where the sold as a mech is going to be a lot safer. Now you might be saying, well, Michael, why would you do a mech if you can't borrow tax free? Right? Well, there's a couple of reasons. Remember, the borrowing of the tax-free dollars is the only thing that you lose when it comes to the tax benefits. Your death benefit is going to remain tax-free, and your living benefits, if it has to pay out, is going to be tax-free as well. So a client might want to maximize his dollars and say, hey, I don't want this, I don't want to deal with probate. I want to leave this money. I want to grow it. And I just want to make sure the death benefit passes straight to my family, tax-free, probate-free. But at the same time, I don't need this money. But if I ever got ill, suffered a chronic illness or critical illness, I get those tax-free dollars. So I get that coverage for myself too, right? And now you don't have to worry about paying taxes. So those are a couple of different ways that you can sell an IUL that it's going to do what it's supposed to do. It's not going to lapse on you. However, when the term properly structured, which is what this video is all about, it's just a myth, right? There's no properly structured. As I showed you, there was no difference in the structures of the policies between the two agents, Brian and the WFG agent. They were just funded differently, right? So properly funded might be a great term. Properly sold, because as I showed you two separate IUL examples that are going to be funded two different ways, but are they both funded properly and going to do what they're supposed to do? Absolutely. Right. And so it's about being properly sold and not being, not the product not being misrepresented. And unfortunately, that's a big problem in the industry. And so I wanted to shed a little bit of light what agents mean when they say properly structured, because the last thing I want you to do is to kind of fall for the language, right? Like the agent restructured the policy and made it safe and took certain language out. Like, no, nothing changed. Nothing changed about the policy, right? All the language is the same. Everything's the same. So it's just important to understand, because ultimately, there's a lot of misrepresentation in the industry. There's a lot of these policies being missold, and there's a lot of these policies that they're just not going to do what the agent told the client they're going to do, right? And so if you have any questions, please reach out, comment, ask me. I'll put my email down below so that way you can reach me. I'd be happy to review any IUL policies that you may have, if go over your goals and see if it's a policy that's going to actually meet the goals that were intended, right? And if not, we can always go and fix that. All right. Have a great one.